Alan, I have been learning salary, dividends, and payroll, but now I see this topic about shareholder loans and benefits. What exactly are we covering here?
That is a very important topic, Raj. In tax planning for corporate owner-managers, this area focuses on how owners take money or benefits from their corporation outside of salary and dividends.
So this is about real-life situations, not just theory?
Exactly. How shareholders borrow money from the company, how they use corporate assets personally, how personal expenses get mixed with business, and how CRA treats all of this.
So this is where most mistakes happen?
Yes. This is one of the most common areas where clients face reassessments and penalties.
What exactly is a shareholder loan?
A shareholder loan happens when money moves between the shareholder and the corporation outside of salary or dividends.
So it can go both ways?
Yes. If the shareholder takes money, they owe the corporation. If the shareholder puts money in, the corporation owes them.
So everything gets tracked somewhere?
Yes. In the shareholder loan account.
Why do so many businesses end up with shareholder balances?
Because most owners do not plan withdrawals properly.
What usually happens?
They take money when needed. They use corporate cards for personal expenses. They delay bookkeeping until year-end.
So the accountant sees everything later?
Exactly. And then we must fix it at year-end.
How does the shareholder loan account actually work in accounting?
Every withdrawal increases the loan balance. Every repayment reduces it.
What does a debit balance mean?
It means the shareholder owes money to the corporation.
And a credit balance?
It means the corporation owes money to the shareholder.
What is the risk if the balance is not cleared?
CRA may treat it as taxable income.
Even if it was just a loan?
Yes. If not handled properly, it can lead to taxes, interest, and penalties.
So how do I fix a shareholder balance for a client?
There are two main ways. Declare dividends. Declare salary or bonus.
So I convert withdrawals into income?
Exactly. That clears the loan account.
How does clearing the balance with dividends work?
You declare a dividend equal to the withdrawals.
What happens next?
You issue a T5 slip. You apply the dividend to the shareholder loan. The balance becomes zero.
So it is simple?
Yes. That is why it is commonly used.
What about using salary instead?
Salary is more complex.
Why is that?
Because payroll deductions apply. Income tax must be withheld. CPP must be calculated.
So I cannot just match the withdrawal amount?
No. You must calculate gross salary to achieve the required net amount.
Can you explain the net versus gross issue clearly?
If your client withdrew $85,000, that is net cash.
So what should I do?
You must calculate a higher gross salary, because deductions reduce the amount received.
So maybe 120,000 gross to get around 85,000 net?
Exactly. That is proper planning.
Is there a way to delay dealing with the loan?
Yes. The shareholder loan repayment rule.
How does it work?
The loan must be repaid by the end of the next fiscal year.
So it gives extra time?
Yes, but it is only temporary.
What if the client keeps doing this every year?
That creates a cycle.
What kind of cycle?
Each year new withdrawals happen. Previous year balances are cleared. New balances remain.
So the problem never ends?
Exactly, and CRA may start questioning it.
Even if the loan is repaid, is there still any tax issue?
Yes, there can be an imputed interest benefit.
What does that mean?
If no interest is charged, CRA assumes a benefit.
Can you give an example?
If $85,000 is borrowed and rate is 2%, benefit is $1,700.
So that becomes taxable income.
Yes,
I keep hearing about Section 15. Why is it important?
Section 15 prevents shareholders from taking corporate money tax-free.
What does it cover?
Shareholder benefits. Shareholder loans.
So it protects the tax system?
Exactly. It ensures personal tax is paid.
What if a client pays personal expenses through the business?
That creates a major issue.
What happens then?
The corporation loses the deduction. The shareholder gets taxed personally.
So it is taxed twice?
Yes, that is why it is called double tax effect.
What if a client borrows a large amount and does not repay it?
CRA may include the full amount in income.
Even years later?
Yes, plus interest and penalties.
So loans must be tracked carefully?
Always.
How do I know if something is a shareholder benefit or employee benefit?
Ask why the benefit was given.
What do you mean?
If given because of ownership, it is a shareholder benefit. If given because of employment, it is an employee benefit.
Why does that matter?
Because tax treatment is different.
If everything is documented properly, is it safe?
Not always.
Why not?
CRA looks at substance, not just structure.
So they look at the real intention?
Exactly. If it looks like tax avoidance, they may challenge it.
What about using a company vehicle?
If used personally, it creates a taxable benefit.
So I need to track business versus personal use?
Yes, that is critical.
Can a corporation pay for home office expenses?
Yes, but it must be structured properly.
What are the options?
Reimbursement method. Rent charge to corporation.
Is CRA consistent on this?
Not always. There has been variation.
Are there any tax-efficient benefits for shareholders?
Yes, medical plans are a good example.
How do they work?
Corporation pays medical costs. It becomes a corporate deduction.
So it is more efficient than personal payment?
Yes, when structured correctly.
This topic feels complex. What should I focus on as a beginner?
Focus on control and structure. Track shareholder loan accounts carefully. Avoid personal expenses in corporate accounts. Clear balances regularly. Understand Section 15 risks.
So this is where most real-world issues happen?
Yes, if you master this area, you will be able to handle most small business tax situations with confidence.